SoFi stock is up over 85% year to date in 2025. And of course, I'm happy about that. I've had this stock rated as a buy all year long, so I'm happy to see the excellent performance of SoFi. It's been one of my better performing recommendations year to date here. But what do I think about the stock now after it's up, approaching $30 a share, near 52-week highs? Do I still think it's a buy? That's the question I'm going to answer in this video. You're not going to want to miss my update. Let's jump right into it. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. So as I mentioned, year-to-date performance for SoFi stock, even though it's down 2% today, it's up over 85% year-to-date in 2025. And I love that because I've recommended this stock as a buy all year long. In fact, I last updated this recommendation on September 10th, reiterating that buy rating on SoFi stock. I keep track of all my buy, hold, or sell recommendations, as well as the dates that I updated and changed these recommendations throughout the year. SoFi stock at $28.44 is near its 52-week high of $30.30. And according to my intrinsic value calculation, SoFi stock now looks considerably overvalued, even after accounting for a margin of safety, which I always like to account for a 5 to 10% margin of safety on the investments that I'm making. But SoFi has been a premium business and is generating premium growth. You don't see these kinds of growth rates in very many companies, especially in companies that are profitable as well. SoFi is both increasing revenue and increasing profitability simultaneously. That makes it a very attractive investment, and that's why the share price has increased by as much this year in 2025. It generated $3 billion in trailing 12-month revenue. That's up from just $400 million in 2019, or in other words, a compounded annual growth rate of 42%. SoFi's business model of offering digital banking and digital services is resonating with customers because people don't visit brick and mortar branches all that frequently. What's more, legacy providers and those that have all those brick and mortar branches have been pulling back, right? The more you go into these brick and mortar branches, and I've been talking about this for several years now, the less and less service they offer, right? They used to have mortgage bankers in these facilities, so you could go to your local bank and talk to a mortgage banker. That's more and more rare nowadays, where if you want to speak to a mortgage banker or lending officer, you have to call and have that service over the phone. So why do you have the physical brick and mortar branch if you're not going to have these services in place, right? Is it only for someone to go in and make a deposit or make a withdrawal with the teller? You can do those digitally now. Take a picture of your check and deposit your paycheck that way, or go to an ATM and make a withdrawal if you need cash. So the reasons for visiting a brick and mortar branch are decreasing, and yet these locations are still around, and the companies that have them are not investing. And so the competitive advantage and the dynamics is working in SoFi's favor. The investments, the products, the new categories they're investing in is resonating, and they're adding millions of new customers every year. They're adding billions in deposits from customers, which makes it cheaper for SoFi to make loans because customer deposits are the lowest cost of capital for most financial institutions, and especially for SoFi. On top of all that, third-party lenders are becoming very interested in making investments in loans. What I mean by that is companies that are not traditionally banks or lenders or whatever investment case they might have, investors are now very attracted in investing in loans. And it's because the interest rates are so high. So you can get, if you're investing in personal loans, SoFi's personal loans on average are 12% or higher. So imagine as a lender, as an investor, you're investing in these personal loans and you're earning 12, 13, 14% on that loan. So that's an attractive interest rate to get on your money. And then when you're partnering with and purchasing these loans from an institution like SoFi, you can be reasonably confident in their due diligence process that they're selecting customers that are less likely to default and less likely to give you a lower return on investment. So that's allowing SoFi to originate more loans because they then just sell those loans to these third-party lenders. They don't have to use their own capital, and that's a very high margin business that can scale very quickly because they're not using their own capital. If you're using your own capital, you can't scale that business very quickly because you need to raise the billions of dollars to make the loans, and then people are paying you back small fractions of the money that you lent out every month. And so it's not a very scalable business in that way. But if you're selling to a third party, you can scale that business quickly because you're not using up any of your capital. You can just make the loan, sell it, make the loan, sell it. You can be doing this all at the same time in parallel without needing to wait for people to pay you back. So all of that is working in SoFi's favor. But I think that's already all reflected in the stock price. The increase up over 80% already year to date. The intrinsic value, $19. Current market price, $28.44. Unfortunately, I'm downgrading SoFi stock today. I've had it rated as a buy all year long, but the price has increased by so much and the risks are increasing. So far, I've talked about all of the benefits with SoFi stock. I haven't highlighted the risk. SoFi still has a large percentage of its overall loan portfolio exposed to the personal loan market. Personal loans are the riskiest loans. When there's a downturn in the economy and people are losing their jobs and they can't make all of their payments and they have to choose which one of their loans that they're not going to repay, personal loans are one of the first loans that people will stop paying in the event of financial stress. They'll still pay their mortgage because they don't want to get evicted. They'll still pay the rent because they don't want to get evicted. They'll still pay the car payments because they don't want their car repossessed. But the personal loans, it's on a lower priority in terms of their overall financial commitments. One of the first things. And what we've noticed in the previous few months, evaluating the jobs market, the US jobs market is slowing considerably. It's slowing down considerably. Very few jobs have been added, not enough to keep up with the new entrants in the labor force. And the Federal Reserve and the central bank is concerned about the direction of the economy. And so they started lowering interest rates. Lower interest rates is good news for SoFi, but the reason for the lower interest rates is not good news for SoFi. If the economy keeps slowing down and we keep if it especially goes negative, where every month instead of the economy adding jobs, it's actually losing jobs, then that can impact SoFi extremely negatively. It's right at the forefront. It's right on the front lines of an economic downturn. I don't expect it to be very bad for SoFi, but when you couple those risks with the fact that the share price is already up by so much and you're paying this very high price for a company that's now seeing these macroeconomic risks increasing, I just don't like the setup right now for SoFi stock. Even though longer term, I like the company longer term, I think it has excellent prospects. In the near term, with these elevated prices, with this kind of macroeconomic slowdown, I would be a holder of this stock. I wouldn't be a buyer of this stock right now. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.